All right, guys, today we have return guest Dean Eigenmann. Previously came on to talk about AAVE stuff. This is like over a year ago, and it was one of, if not the most popular episode I ever did. I think maybe because people don't usually get insight from people actually doing AAVE stuff because they're quite closeted about that. So yeah, awesome to have him back on. This time has completely pivoted away from trading, and we're going to get into all that. So you don't need to go into too much background, but let's just talk first. Like, when did you move? Like, when was this kind of transition now into what you're doing now?
Yeah, so we sold Project Blanc, or the conversations for an acquisition started almost 2 years ago. And, getting that across the line ended up taking about a year with all the legal overhead that goes into an acquisition. And then I've been out about 6 or 8 months, something like that. And within that process, I've been kind of thinking about what to do next and where I really want to put my focus, which is, how the discussions around Markets Inc. started together with the co-founders, Jenny and Ash.
So like before, I don't know how much you can sort of disclose. So obviously feel free to keep, anything that's kind of non-public, private, but out of curiosity, just on sort of selling a trading shop, like what does that look like in practice? And also maybe this kind of goes into like the MEV landscape, like who is still active in that space? Has it become much more competitive? Like what are your just overarching thoughts there? I assume that had like some influence on you deciding to kind of pivot into something else.
Yeah, the sale was an acqui-hire.
Okay.
I had kind of been looking at exit opportunities. The who's still active in the landscape, not sure. I was talking with the guys over at SCP recently. They're obviously still active, but from others, it's hard to tell. Especially, it's even harder to tell, like, all the rumors around 1010 and who blew up left and right. Mm-hmm. There's a lot of unknowns, I think, in the market right now.
Yeah, that makes sense. Okay, so then you took a little bit of time off, the transition period, 6 to 8 months. You're diving in now to Markets Inc. What is Markets Inc.?
Yeah, so, almost 2 years ago, Ash came to me with this idea for a new fund. And so TLDR is we're doing a fund, but it's not a venture fund. We're having a liquid focus, and we're thinking about how, a active and more traditional allocator would look in this space, and taking an activist role in some of the investments that we do, being very concentrated and kind of taking inspiration from TradFi, how some of those capital allocators function, and try to bring that to the crypto market. Generally, we're of the belief that a lot of crypto's market dynamic right now is the way it is because, you have an overhang of venture funds who are sitting on, 50 to 100x multiples of what they invested in. And there's no marginal buyer for any of this stuff. And the reason why there's no marginal buyer is, that there's no institutional player who is ready to buy any of this stuff when fundamentals just don't make any sense. And so we're, trying to become kind of a forcing function for some of these protocols to, not just obviously make money in the space, but also, help the industry mature, especially with where we see the space going over the next 3 to 5 years.
So are you taking outside money, or is this like a family office thing?
Well, we're raising outside capital, yeah.
Got it. Okay, so like talk me through when you say, I mean, I think a lot of people have been realizing this as of late, and it's pretty much spot on. There's been tremendous number of tokens, and it's hard to figure out who's kind of coming in to buy, right? Like liquid funds in the past have been trading these. The dynamics a bit different now. It doesn't seem like there's as much demand. Talk me through like what you are specifically looking at. Like you don't have to give me specific investment, but if you want to, maybe, a token or something that you think sort of fits well into your focus now, just like for background, maybe,
So the kind of framework that we're looking at which to analyze these protocols with is multifold, right? So we're kind of looking at protocols who have revenue, who have durable revenue, right? Have gone past the stage of subsidizing liquidity using token emissions. They have some kind of product moat, a durable moat. I don't think liquidity is a product moat insofar as like crypto always discusses it. I think, over the next 2-3 years, we're going to see liquidity become a building block in most of these products anyways. And it's going to flow more freely. And so there needs to be some kind of moat. There needs to be some kind of durable revenues, and there needs to be some kind of disconnect between what we think the fundamental value is and what the book value is, or what the trading value is of some of these things, right? And so, I think some of the projects that are interesting to look at is something like Sky, which is trading at a 10x PE multiple or PT multiple, and it has growth that's quite decent and has durable growth and has a plan to scale that growth over the next, couple of months to years.
So when there are these kind of like disconnects in valuations, perhaps like some projects look quite appealing and yet they're, trading down, or it doesn't seem like the market has necessarily, formed the opinion that this is durable or sustainable the way that maybe you have on other tokens. Do you think that is like, what do you think goes into that? Like the obvious answer for the past 10 years has been the regulatory landscape, or that's one of the big ones, right? It's like, we can't, put strong property rights around these things. Maybe we're getting better, but like that is one of the big ones. Is that in your mind what is shifting? I mean, we'll go into sort of some of the stuff you've written, but is that like one of the big ones? What are other, sort of these like disconnects in valuations where you can come in and say like, we want to look at this, through the fundamental lens? I know another guy like Thea, Felipe, right? Like very, measured and rational. I really like them and they have the right approach, but it's still hard, right? Like these liquid tokens have been like, it's been a difficult game, especially in the past couple of years. So, I mean, is it regulation? Like where's your head around that and like maybe going forward?
I think regulatory is a huge unlock, right? Like most tokens should function like equity, but haven't been allowed to function like equity. The regulatory environment we've had has been incredibly hostile. But then I think one of the root causes right now is that market dynamic that I, previously just talked about, is the unlocks and overhang that you have on some of these tokens. I'm sorry, but some of that just needs to clear because it's so toxic, right? I wrote an article a couple of days ago about buybacks where, like, it looks like Snapchat has done $10 billion in stock-based compensation and their market cap now is $9 billion. The difference though with Snapchat is that they have marginal buyers, right? Crypto doesn't have any marginal buyers. All buyers are discretionary right now and they're predominantly retail, right? Like in TradFi, you have 401ks, you have liquid funds, you have ETFs that are auto rebalancing. Like you just don't have that in crypto. And so like, if there's such an overhang, of course, a discretionary buyer isn't going to move into some of these positions because they just don't, they're not healthy positions to take whatsoever.
Yeah. Okay. Let's go into the point about buybacks, because I read your piece and I, very, very much agree. So you kind of focused on the crux of it. You kind of focused on two examples. One was Helium and the other one was Jupe. So like, give me an overview of like, for example, the one with Helium, which I think you're spot on about. Like, what was sort of the point you're making there with regards to buybacks?
Yeah, so I mean, Helium was doing all these buybacks, and then at one point came out and they said they're going to stop, which I fully agree with, because the cost, like, essentially, a buyback is an investment decision that a firm has to make, right? And the matrix that you have to go into, or the calculation that you have to go into, is like, what is like the most efficient investment that I can make as a firm into with this dollar that I have, right? And once you've run out of investments, you can go to a capital return structure, which is something like buybacks, right? The problem with Helium, for example, is, they're in a high growth phase. The more efficient thing to do with that dollar instead of buybacks is subsidizing growth, right? Like for Helium, which, is, you buy hotspots and things like that. Like, does it not make more sense to subsidize the cost of a hotspot to have higher distribution than it does to buy back tokens that are going to go down anyways? Because, I mean, in the case of Helium, they're deflationary at this point. But in most other cases, like Jupiter, for example, the token's going to go down anyways because you have billions of dollars worth of unlocks that are yet to hit, right? And so it's that meme of, like, the boat that's broken with the guy with the cup trying to shovel water out of the boat. Right? Yeah. It's like you're coming to the London fire with a little squirt bottle of water and hoping that you can save your house.
Yeah. So I think a lot of this probably stemmed from Hyperliquid doing very well. Why do you think that, for example, Hyperliquid has had success and shown their buyback model versus some of these others? Like I have my own suspicions, and I think there's legitimate reasons why Hyperliquid maybe, going a different path. But like, do you think that the market just saw Hyperliquid buying back tokens and then the token going up, which at the time obviously it was somewhat surprising because a lot of tokens have not gone up, and just kind of like latched onto this. Yeah, like maybe do you think that was kind of like the impetus for this?
So I think Hyperliquid is a super interesting one. I mean, they were kind of the first ones to do it in this programmatic approach that they did, right? With the constant buybacks. I think the important aspect of Hyperliquid is that Hyperliquid produces so much revenue and they didn't have to sacrifice any other investments that they're making in their organization, right? They're an incredibly streamlined organization. I think there's still 11 employees. The buybacks have not stopped them from being able to allocate capital in an efficient and smart manner and grow their business, right? HIP3 came after the buybacks. HIP4 is on the way now. They've proven that they're a team who can execute and will continue to execute, and their buybacks haven't been something that's changed that calculus. And I think a lot of teams, it's changed the calculus, right? Because they're spending money that they don't have on revenue that's not durable to buy back a token, which is essentially just buying it back from all of their investor float and team unlocks, right?
Yeah. It is like, I completely agree. It's circular, and oftentimes it's very bizarre. Like buying back, in certain scenarios, like buying back a token that's like functionally worthless. It's like, this is not, and they're not even necessarily using the revenue, right? Like it comes from just like their treasury. Yeah, exactly. Which is like, okay, this is clearly not how to incentivize growth. Is Hype, for example, a token that you guys would look? I'm just trying to get an understanding, maybe of market sync. Like, is Hype a token you guys will look at, as a liquid investors?
Hype is one we're very interested in, and I think like Hype is interesting from like it's kind of past the inflection point that we usually look at. But I think it's such a good business and such a high growth business that I think will continue to keep growing, that as a growth investment, it just makes sense. One of the things I'm following closely is HIP4. Like I think prediction markets kind of are limited right now in that, it's essentially gambling. What's interesting about having it, I think, in a more market structure like Hyperliquid and with a team like that, by exposing it through HIP VM and things like that, is like, what other interesting products can be built on top of it, right? Like insurance underwriting and all kinds of hedging products that weren't possible today, if liquidity is deep enough for those kinds of markets, right? And so I think like their product line is going to keep growing. I feel like Hyperliquid is going to be like, the like Revolut, or I think it's Robinhood style thing where they have like 10 product lines that are each generating more than $100 million in revenue.
Yeah. So you say it's sort of like past that inflection point. When you say like you're going to be strictly liquid, so it's not going to be any venture investments. Okay.
No.
So when you like, that's interesting. Like I sort of think I know what you're talking about when you say inflection point, but like what does that mean? Like I guess you're probably looking at something with like slightly higher upside. Is that like generally the idea? Yeah. And like, go ahead.
My thesis right now is that like, there's a lot of like in the statement I wrote something like, trillions of dollars are moving on chain. That's going to happen. We're seeing that already, right? We're seeing it in a very slow, and the cascade is going to follow. And the DeFi products that are built right now are going to become critical infrastructure, right? Look at Morpho with their deal with Apollo, with the backing of Coinbase, right? Like all of this is going to be crypto mullets where you have TradFi in the front, DeFi in the back, and these DeFi things are going to be repriced as, the businesses that they are. And so I think that we will see venture scale returns in selective picking like this.
Yeah, and I've always been kind of curious, like with venture returns, it's obviously like highly dependent and on the market and the timing, but a lot of times venture firms are looking for those like very asymmetric upsides, and they're looking for 50, 100x's, right? Like 10x, yes, but like even that is one of those things where you really need a few sort of like this power law distributed outcomes to carry a fund. Compare that a little bit with something like market sync. Like where do you guys look at? I know this is a very kind of nebulous question, but are you like trying to swing for 10x's, clean 5x's with like maybe relatively low downside, 100x's? I mean, again, this is a question that's like very kind of nondescript, but I am curious, like maybe just distinguishing a bit where something like market sync fits in versus, a seed stage investor or early stage angel.
It really depends on the project that we're going in, right? I think with every project that we're going in, we have a very clear framework for, why we entered, what we think we can help the project achieve, and when we're happy to exit, right? Which is, when the token has repriced to its fundamentals. I will say, however, I think the contrarian take is that I think we can perform as good, if not better, than venture funds, because, look at I remember reading a report in about 2022 or something, which was that in the Cayman Islands, there's 700 and something crypto venture funds, right?
Yeah.
Like the amount of people competing for, getting in on rounds there because of their mandate is absurd, right?
Yeah.
And what has that created? Rounds are still going higher and higher, and we've seen that public markets aren't able to sustain those valuations, right?
Yeah.
How many things over the past 6 months have we seen that launched at their latest stage valuation and are trading drastically below?
Yeah. No, we've definitely seen like an extreme repricing, and I think a lot of people expected this, but a lot of the gains were mainly realized. I say realized like a little bit, tongue in cheek, because it's hard to say whether not anyone's going to get their full amount. But a lot of the gains have been realized, right? Like in these private rounds, and then these tokens are launching at valuations where it does not, like you said before, seem clear where this kind of marginal buyer, liquid buyer comes and steps in. Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the Prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.com/careers. Okay, so this is like another thing that's interesting, and I kind of defer to I think the only, or maybe I've talked to two, but one of the only other liquid investors, Felipe, and I am curious, like when you talk about kind of helping the projects, like what does this look like in practice? We have activist hedge funds, right, and they sometimes take like a positive approach, and then other times you see people like Bill Ackman, shorting something and then releasing documentaries about how it's all a scam or something like this. So, but there's different ways to have an impact on what you're trying to invest in and see it succeed. I assume that's the case with you. What does that look like in practice? Are you going to founders and like helping them? Like what is the kind of, I know you're in the early stages, but like what's the long-term game plan?
It really depends on the team, and obviously, our team has a lot of experience. Ash was head of growth at Uniswap, and before that at Maker. Jenny was at DAppHub, which worked closely with Maker, and then head of product at AAVE, right? And so, like, we've each been in organizations in this space that are all unicorns, right? We've helped teams build, and our input can look, working with the founders, if that's something if that close connection doesn't make sense anymore, making governance proposals, executing on those proposals, thinking about tokenomics, helping redesign stuff like that. So it really depends on the protocol and what the stage is of the protocol. But my opinion is that I want to work with founders. I kind of want to take a very venture approach with how we deal with founders and things like that. I don't care to be hostile. I think the mantra of, believing in the future and betting on things that you think build the future is more productive than shorting things that we think are bad ideas. Even though, in a healthy market, you should probably have a player like that. I just don't know if it's the right time yet in crypto, given its maturity, to be that player. You've seen it with all the random, meme coins that pump on, pretty much nothing. I think it's hard to take a very structural activist approach and short position when the market still kind of doesn't trade on fundamentals at all.
Yeah, and also, I mean, I think we can all. It is kind of frustrating in a sense. Not that I would necessarily be some expert at shorting these things, but there's a lot of variables that you just don't want to play around with when it comes to shorting these things. Like you can very easily be squeezed when the liquidity is very low. Also, there's just very like with meme coins, right? We all see these charts go up 100x. We're like, okay, yeah, this is coming down 99x. And yet like the ability to actually put that into motion or take a position on that is virtually impossible. So yeah,
the problem is with some of these shitters is exiting your short if it was successful.
Oh, right. Exactly. Yeah.
Like,
you can slip like out of your mind. I know. It's like, I definitely think the execution is, yeah, it's unfortunate, right? Because like a lot of money goes into pumping these things, but then bringing them back to fair value is near impossible. And it ends up like mainly the three people who bundled it are the ones who end up making the money, you know? Okay. So I read this so by the way, I recommend everybody go and check out, is it marketsinc.com or .org?
Markets.inc.
Okay, market setting. There's 3 papers on there. There's another one, and now I kind of want to ask you about different sectors. So you talked about hype, perps, a lot of the interesting things there. They could have 10 different verticals where they're generating a ton of money. But in this one piece you published, it was talking about real-time trade finance. And, you know, it was like kind of something that I think a lot of people have been recognizing, which is that a lot of markets are moving on chain, and stablecoins are really like facilitating this. Yeah, talk to me about just like maybe give me an overview with that, and then we can dig into like how you kind of intend to express those views.
Yeah. So the interesting thing about trade finance is, you know, Reuters put out this article, and I don't remember the exact number. I keep forgetting if it's 2.3 trillion or 23 trillion. I think it's 2.3 trillion funding gap in trade finance, right? And that's because, you know, a lot of banks aren't able to inventory finance anymore. And private credit is just too expensive for some of these things, right? So the example I gave is, you know, think about a manufacturer in Mexico manufacturing, you know, call it $10 million worth of goods, delivering it to the US. And once things get past the border, you know, they get paid and are able to start using that capital productively within their organization again, right? The problem here is that while those goods are in transit, the manufacturer is holding onto the inventory and they're unable to get any sort of liquidity on it, right? The reason is, as said, banks aren't able to finance it. But even if they were, the due diligence process for something like that is, you know, in the weeks. And then for a transaction to clear from the US to Mexico, or, you know, in the more extreme from the US to China, by the time that is cleared, the loan term would be done anyways, right? But the productivity boost that you get if you're able to finance something like this is huge, right? Like think about these factories who have, you know, at any given moment, hundreds of millions of dollars of goods in transit that are having to put up their own capital again on the other side to be able to, you know, execute on their next deals, right? It's a largely capital inefficient business. And I think what's interesting about it, and I keep telling this to people, is that it's a market that hasn't been able to exist without crypto, right? And this is what we should be going after. It's not just bringing TradFi on chain. It's a TradFi market that is inherently impossible to execute on within the current like financial services with the way they currently function, right?
Okay,
like,
so
it needs crypto.
Yeah, like so from my reading of it, essentially the you know argument and the thesis is like, look, we have all of this liquidity and stablecoins that can be sourced anywhere in the world at any time. And, you know, given the right design and, you know, probably like hopefully risk curation at some point in the future, things can be financed in a much more efficient and, you know, time sensitive way. Is that sort of like the driving idea here is like with all of this liquidity, with all these stablecoins, like we can put these to work much more efficiently. And is it stablecoin specifically when you say crypto enable this?
Yeah, I think it's stablecoins, you know, but the other interesting aspect of it is like crypto yields are going to go down. And, you know, the Fed has shown us that yields are going to continue going down. And so crypto yields are like a weird function of like, what are, you know, real yields? What is the cost of capital and what is the cost of moving capital, right? And at one point, real yields are going to go down so far that a lot of the unknown risk pricing that you take in crypto just no longer justifies the yield, right? And we saw this with something like Balancer, which, you know, for most of us is a secure protocol, but after 4 years got hacked, right? And so I would, you know, if I can get an RWA product like this where, the person, the off-chain lender owns the inventory and is able to recoup losses in case of default. I would much rather take a position like that than take a position, in some esoteric pool. And the other aspect of it is, I think, crypto is coming to a place where it's mature enough where we'll be able to start trading these markets the way we trade any other markets, where, all of this data comes on chain that helps us analyze risk and price risk more efficiently than we were able to do before. Then you have vault curation plus, these market makers essentially for these kinds of vaults.
Yeah. Just like quick question I thought of. Will Market Sync invest in equity or exclusively tokens? I mean, I guess long run, hopefully.
Long run, I think, both, but in the flagship fund, we're really thinking about tokens right now. Like, I'm firmly of the belief that, most of finance is going to move on chain. I think at one point, you're not going to be able to distinguish between tokens and equity. And yeah, we're a crypto native firm, and we want to put the products to use that, we've grown up alongside.
Yeah, I think so. Specifically with stablecoins and this idea that you're kind of talking about now, I think one of the big, grievances, if you will, with especially retail is that we all see stablecoins with tremendous growth. We see, like everybody has some stablecoin strategy. Like it's very clear that there's a future here. In terms of investing or expressing this view, it becomes a bit more difficult, right? Like Circle equity is one, proposed idea. We've had a number of stablecoin chains like Plasma, and then I guess ARC is coming soon. How do you view expressing this? And, like what looks favorable in terms of like really margins and growth in the long run, right? Like we can all sit here and agree that stablecoins are going to be the future. And then it's like when we come to invest in, it's like, well, you're not going to just buy stablecoins, right? So like, how do you kind of center that maybe?
It's kind of a funny question, because when I was thinking about like what to do next, I was talking with some of my friends who I usually go to for advice, and they were like, why don't you do another venture fund? And I said, the only thing that's venture, or the only thing that's investable right now in the space is stablecoin and stablecoin infrastructure. And that's just not like something interesting to invest in for me, right? In the end, none of it is a technology problem anymore, I think, or the sets of tech problems that exist there are relatively low and solvable. It's all regulatory, like I was also thinking about like, do I do a startup? Do I do a startup in stablecoin? Okay, but then the only thing I'm going to do is talk to lawyers, which over my career of, the past 6-7 years in this space has been my least favorite activity, and one that I feel has taken up way too much of my time. The question you set there is with the stablecoins is like, is that a sector that you can productively get exposure to? I think right now, not, other than, with something like Sky, AAVE as a proxy for Go. I think that the interesting places to take positions on is asset the businesses that are being enabled by them, right? Like if you look at a lot of these stablecoins now, for example, CAP, it looks essentially like a money market fund, right? So getting exposure to that money market fund. I think that's where the interesting thing lies, because of the the productivity boost that is gotten by lowering the cost of doing business, essentially.
Yeah, that makes sense. Okay, what other sectors maybe? Like, so I guess, again, we've talked about hype now a little bit and potential there. So that's like perps, trading. Is there anything actually on that note, is there anything else in exchanges or trading that interests you in terms of like being really valuable going forward? Like, throwing out an example, something like Uni or Uniswap or not. Have we kind of defined winners and less interesting now from a liquid perspective?
We haven't defined winners, and I try to look at everything. I think there's good, like the DeFi stack is I find an investable like stack as a whole. At my old fund, I when we were thinking about what to invest and we were kind of investing across the board, I at one point said, listen guys, like crypto is financial. And the only use case that matters for crypto is the financial use case, right? I just want to invest in things that enable new kinds of financial interactions. And so that's what we're focusing on. So, Uni, I think, is a super interesting product. We need to check whether the fundamentals there align, as we do with any product that we're currently looking at. But, I'm really looking at everything.
Yeah. When you say like exclusively financial at this juncture, what does that mean in terms of what you will not invest in. Like, and I think a lot of this goes to the last bull run maybe, and then a lot of the kind of token overhang we've seen since then. Like, what is very much not interesting to you at this point?
I wouldn't touch anything that's crypto social. I wouldn't touch anything that's like NFTs, anything that's purely consumer without having a financial aspect. I wouldn't touch.
Okay, you mentioned Helium in that post, mainly with regards to their, like how the token dynamics is working is like a little bit of a different angle. But like, what about DePIN in general? Like, I think there's been a lot of discussion about this. It's sort of interesting because maybe DePIN is just ultimately facilitated by stablecoins, and like a lot of these ideas that we had with regards to it being crypto specific isn't so true. It's more just that, something can be speed run. But like, do you have any thoughts about DePIN? Obviously, like I have had, Kyle on before, Samani, and he's like super keen on, or was, I guess, super keen on DePIN. And I think that's one that's always kind of, people have polarizing opinions. Like they either think it's the future or they think it's like mainly trash.
Tough one, right? When I was working at Status, we were kind of looking at DePIN stuff as well for messaging protocols and routing and things like that. And yeah, the question you asked there is like, do we just need to build what we've been building before with stablecoins?
Yeah.
Helium seems like an interesting one. I haven't dug that deep into it beyond, the Blockworks dashboard on their pricing and things like that. And, the scouring on their recent growth and everything. But yeah, as you say, the question is like, does the whole decentralized infra part there add that much benefit over what is existing already?
Yeah, I guess like one of the ideas is that the ability to bootstrap in some capacity, like for example, with Helium, obviously they can pay out a inflationary token that incentivizes people to connect. I don't think it's really been proven. I don't know of any that have shown sustainability and or very promising sustainability beyond the fact that they are paying out an inflationary token to do something like this. So the idea sounds good in people's minds that tokens can enable this, but then it's like the reason tokens enable this is because people then sell the tokens, Yeah. So I don't know, but yeah, that's like mainly been my thought as well.
Yeah, it's essentially like you have a high upfront cost for user acquisition, and the question is what happens when the musical chairs stop.
Yeah, exactly, and that's been we mainly seen stop.
Can you get to a point where your network is durable enough for you to turn off your token emissions?
Yeah, go ahead.
Which is a question that all of these protocols kind of face, right? But when you don't have a direct kind of, I think, use case for your token, it makes it a lot more difficult. And when your token is only a payment token, you have the added question on top of that.
Yeah, I want to go back to for 1 second. We talked about this like inflection point, and like Hyperliquid does seem to have kind of crossed that chasm in a sense because they did this massive airdrop and people were farming that airdrop. People are still, whether or not it will happen, people are still farming an airdrop, but they have sustainable users. Like it's fairly clear that of all the projects, perhaps in the past 5 years, the retention of like true demand for Hype is probably the best of any project out there.
Yeah.
That inflection point, though, I think is a lot of times very difficult to discern in crypto. And like I mentioned Uni before, I look at the numbers on Uni, it's like very hard to it's very hard to find a $4 or $5 billion whatever it's trading at valuation, right?
Yeah.
First of all, maybe this is kind of two-part, I suppose. Apart from Hype, are there any projects that you think have truly crossed this kind of chasm where there is clearly some like floor for sustainable demand that you can count on when you go to make a liquid investment? The second question is, what does that look like in practice, right? Because like slowing down emissions, for example, with sustained demand is good, but really ideally you want it to be like very close to a long run equilibrium, right? But maybe early stage investing, we're not like quite there, but I am curious like how you think about inflection point. So yeah.
Yeah, that's interesting. So I mean, for other projects that have proven their durability is Bitcoin and ETH, right?
Yeah, exactly.
So
maybe Solana to some extent. I mean, their emissions are still high, but I think, and also I say Solana to some extent. I don't know what that looks like in 5 or 10 years, but I do think there is like some residual demand there, right? And but the emissions are still kind of high.
Bitcoin, ETH, Solana, maybe. Solana is kind of an interesting one. I wrote off Solana for a long time because I thought it was just, casino, and there wasn't anything of value being generated there. I've now talked to a lot of, or, a couple of months ago, kind of changed my opinion, that maybe some of the things that are happening there are interesting. AAVE is probably another one, but, with AAVE is going through now, I think what is like for us as an activist player to kind of, think about whether we get involved or not, throughout this drama. And the question is, does it survive? Right. And if it does, it obviously comes out stronger. But like, what does this entire process look like?
No, just because it's top of mind, actually, like usually I don't focus too much on current goings on, but how closely have you followed the AAVE drama? And to the extent that you have like an opinion, I'm kind of curious.
Very closely. I think my opinion is clear from already past points in this conversation is I think tokens should trade like equity. And I think that it is in a protocol's best interest to align their economics with their token holders. Usually founders are the biggest token holders anyway. So, you're just accruing value to your transferable equity anyways, because, if you try to get liquid on your lad's equity, good luck. Really hard to do so, but you can get liquid on your token equity, even if that's not selling. You can borrow against it and things like that, which in many cases you can't do against your lab's equity. I think one of the things that the AAVE team brings up quite often is the whole point of you can't have the DAO vote on everything. You can't have the DAO vote on everything. We still need to build product, but I think that's often a red herring. The DAO doesn't need to vote on everything. The DAO just needs to vote on, once a year, do they give you budget because they believe you've been good stewards of their capital? And if you have, you have another year and don't have to worry about it. And I think, having those checks and balances in the end becomes probably productive for an organization. And I think you can function like that. I think the problem with a lot of DAOs is they become like too decentralized very early on and haven't like had this product mindset and how to like foster a good relationship between the shipping part of the org and the DAO. And they've kind of, tried to make everything too decentralized and have every opinion be formed by the DAO. And I just don't think that's necessary. I think you can kind of have a middle ground in both worlds.
Okay, this is like the honest truth. I haven't followed the AAVE thing too closely. So when you say that tokens should trade like equity, which I think is a very reasonable take, which side? So like my understanding, correct me if I'm wrong, but there's the AAVE team who are the shippers, and then there's the DAO led by sort of this like well-known guy who's like very vocal and has been, he's been like quite supportive of AAVE, so do with that information what you will, named Mark, and they're kind of at war right now. I'm curious, like in your opinion, when you say it should trade like equity, which side is better representing that, like more the DAO side or like sort of the team side?
I mean, I think that, the drama originally started because of the front end fees of that labs had implemented in the AAVE front end, right? And their comment on the matter was, AAVE needs to produce revenue. They have a mandate to do all this stuff and blah 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 blah. And just from my core point, like without looking any deeper than that, from my core way I feel about tokens is that revenue should go to the DAO, right? I think revenue should go to the DAO. I think it's really hard to like differentiate between DAO and labs, right? Like if you say labs owns intellectual property, it's really hard when you're asking the DAO to kind of be your risk, getting away from any risk is the DAO, but they're not getting any economic rights.
Yeah.
It's really hard to justify, I think, from just like how I would look at fiduciary duty, right?
For sure. Well, I mean, I think like you can take a very pragmatic approach and be like, the Apple shareholder also owns whatever the IP, whatever the claim on everything that Apple has, and that's one big aspect of this, right? Which is like there's no, and I know this is, to be fair, this has been like a lot of this has been a function of the sort of uneasy and uncertain regulatory thing. So I get that, but if we can like put that aside for a second, right, and realize what's going on here, I mean, it's very clear that the token holders should be able to receive any and all sort of revenue or profits from like residual revenue and profits from the token they hold. So that's a big part of it. I think you mentioned Morpho earlier. They did something sort of interesting, I think, right? And like really streamlined their token in an attempt to sort of move in the right direction. Is that like, I guess you...
I'm fully starting to look at Morpho. I haven't like fully looked at their model, but I believe from my understanding is the DAO owns everything there, right?
Yeah. Well, I mean, it's like all under one umbrella, which like should be the thing going forward,
like,
right?
Listen, I think the DAO and Labs situation like happened post the whole like foundation situation, which was, you know, the great Swiss invention, which I think was bad design as well. It just, you know, led to companies that can't execute fast. And then we had the DAO and Labs, and that was, you know, a function of American lawyers trying to, you know, read between the lines of the previous administration's regulatory enforcement and how they perceive that things will be enforced, right? And so what we've done is we've offloaded governance risk away from labs, but given it all economic accrual. Which, how does that make sense? How am I the steward of how, you know, value is accrued, but then I don't see any of the economic upside of that.
Yeah. No, I completely agree. I wanted to ask, you mentioned before, but I wanted to get a more fleshed out opinion. And also because you have a lot of experience in trading in general, markets, faster moving markets, right? Like venture, for example, prediction markets, huge thing right now. Like, give me your overarching view.
I think like, you know, prediction markets are semi-interesting. I think right now in their current deployment, they're relatively boring. You know, that there's this whole language around how prediction markets aren't gambling. I'm sorry, they're gambling. Just because there's no house doesn't mean it's not gambling. If I'm playing checker, if you and I are playing dominoes on the street and there's money involved, like it's gambling, right? Yeah. Like even if there's no house, you know, it just is. But like, there's interesting products that can be built on top of that, like hedge products. We were thinking about it from like a governance activist standpoint as well. Like, how do we hedge our governance votes in case they don't turn out the way we think they will, and what we think that how that could affect the token price, right? And so there's really interesting products that can be built on top of all of that, and we're kind of like starting to think about that. But yeah, I think, you know, sure, let the kids gamble, but like I think we should just be honest about the fact that, you know, it is gambling.
Yeah, I completely agree. I have grown more interested in prediction markets. I still have a lot of the same kind of reservations that a lot of people have. I think that it's true that you can use them for hedging. It's true that you can sort of like use them as insurance. That stuff is interesting. I will say one thing, I don't know your view on this, but I'm kind of interested. Like, one thing that I do think about prediction markets, I think it's in an ideal form, I think they're permissionless and non-KYC directly. I think that if you want like the most, I mean, it sounds like incentivizing insider information, which is kind of part of it, but I do think that something like a lot of things that reveal information from Polymarket couldn't be revealed on Kalshi. Like that, I think that's a fact. Now, whether or not governments are cool with that is a different, you know, set of kind of like discussions altogether. But I have, you know, with like HIP-4, I guess, and some of the kind of binary option, like perps ideas that people are pursuing now, I think it's like you really do need people to be able to just, you know, spin up a wallet and place a prediction if you want like the most accurate information. I think that part is cool, but it really does start to lean on kind of, you know, is it all for insider trading? You know what I mean?
I'm no lawyer, and so, you know, I just look at some of this like regulatory gymnastics that's being done to justify that these things aren't gambling, to justify that insider trading is fine. You know, the argument is of market efficiency with insider trading, but then like the question is like, if you're allowed to insider trade equities, isn't there a higher market efficiency as well? So why is this reserved for one class of markets, right? Like, why don't we just even the playing field and allow insider trading everywhere? Which, you know, like I fully don't understand it, right? Like it really just seems like, you know, people trying to better trading.
Yeah, it is really, I think that maybe the most interesting thing, like at a meta level, and I'm not the first to say this, obviously, but that prediction markets have shown is kind of just how we think about what insider trading means in practice and like how we define that. And it is like a very bizarre line, right? Like, I don't know if this is real. It could be a complete BS, but there was this guy who, it may be AI, but this guy who allegedly went and recorded the national anthem at the Super Bowl beforehand and like stood there outside and like saw how long it was going to take and placed a bet on Polymarket. And people are like making comments about like whether or not this is, insider trading. And it is hard to kind of like think about this when there are analysts on Wall Street who have direct lines to pharmaceutical companies and are able, and that isn't necessarily insider trading to be really, really knowledgeable about like the next Alzheimer's drug, right?
Well, I think that's the thing with a lot of insider trading regulation and why it's so hard to enforce even in traditional markets is it's very hard to say what is insider trading, right?
Yeah.
Another relevant thing right now is this Jane Street lawsuit that got opened where the claim is that they were trading on material information, but their transaction was executed 10 minutes after, the Terra Foundation pulled liquidity, right? Which for a fund, it's easy to argue, they were trading on insider information because they had pre-existing information that they knew what the withdrawal was about. But on the flip side, any fund that has, multi hundreds of millions of dollars in a capital pool, if they see the foundation pull from that capital pool, it's part of any risk management to take cash out of that, right?
Yeah, that lawsuit seems like very spurious. I mean, I don't know.
It's one of those typical ones, the liquidator is just trying to get more cash out of the situation.
Yeah, that one was like, come on. Okay, I'm curious if you followed I think you were kind of joking about this, the Jane Street Bitcoin 10 a.m. algo.
Yeah.
Sounds pretty like, okay, so at first it sounds like quite ridiculous, but then people have like really run with it. So I don't know, but you're like quite experienced in trading markets. I'm curious, like, is there any validity to this, do you think?
Well, listen, like I'm not that deep in those kinds of trading strategies. It sounds sci-fi, but like you do come in with the caveat that Jane Street got banned from Indian capital markets for running strategies like this, right?
Yeah.
And so, like, could it be bullshit? Is it bullshit? It's crypto rumor mill. It's, 75% it's likely bullshit.
Well, also the people commenting it almost certainly have zero idea, right? Like that's the first thing.
That's the issue with a lot of these like crypto Twitter accounts who keep talking about like, Wintermute is doing this, Wintermute is doing that. It's like, they're not fucking doing anything. They're moving client capital around. Like Wintermute isn't dumping. They're putting money on an exchange when their client asks them to, right? I think, a lot of those accounts are, but it is, I wish I would have more time to look at it more deeply and try and understand what's going on. It is interesting just asset because, Jane Street has been banned from various capital markets for executing strategies that are unethical at best.
Yeah. And they have quite a bit of power, my understanding, regardless of whether or not it's true. They have quite a bit of power with, the redemptions and like the sort of ETF and then their kind of like liquid strategy, right? There's the ability to, I don't know, again, this is like sort of beyond what I understand about this stuff, but yeah, I agree. They were banished from India for, right? Like
literally almost the same thing, right?
Yeah. Okay. And then markets.inc is your website. So everybody go on, read the thesis. And then what is your Twitter? At Dean Eigenmann?
At Dean Eigenmann, yeah.
Awesome. Well, thank you for coming on for the second time. It's been fantastic. Glad we got to get a different side of, from MEV to now working to help promote the space and a positive sum. Not to say that MEV was negative sum, but yeah, just a nice pivot. Okay. Thanks, Dean.
Thank you very much.